Hey, good morning, everybody, and welcome to Trading Places Live. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com. It is Tuesday, February 10th, 2026. Pleasure to be with all of you today. Pretty good day in the market, coming off of the test of key support on technology and on the S&P 500 last Thursday. Markets reacted pretty nicely. We had a really good day on Friday, bouncing back. I've seen a lot of strength. Not necessarily in technology, although we did get some yesterday. Technology did lead the market yesterday, which was nice to see. But we did see some strength, and we have been seeing some strength in other aggressive type areas. Not, I call them like the aggressive value. There's defensive value and there's aggressive value. And industrials and financials, to me, are more aggressive value. It's better to see strength coming there from those two areas than it is to see strength leading the market in, say, staples or utilities or real estate, which are more traditional defensive areas in the market. So we don't want to see defense leading the market to the upside. So when technology, and I've been doing a lot of research here of late, just going back, looking at different periods when technology has not performed well. And it seems as though, for the most part, when technology is picked up by financials and industrials, we have a much better chance of at least holding serve, not losing too much ground to the downside while technology kind of does its thing and regroups. But almost in every situation, during almost every major advance, we've had technology leading the way, or at least certainly participating and leading in some fashion. So anyway, I do find, and I talked about this a little bit over the weekend, I do find the fact that we held on to the major support levels. That was comforting. Obviously, the alternative is not a good thing. We don't want to see the market starting to fall apart. We don't want to see key areas of the market lose support, because that's just going to open the door to more shorting, much more selling interest. A lot of tactical folks that have been holding will start to maybe sell when you get breakdowns like that. So that can lead to a lot more weakness. So fortunately, we avoided that after the close on Thursday. Remember, that was when Amazon reported, and it looked like, oh my gosh, Amazon was down 10% after hours. The QQQ, it looked like, was falling. XLK was down below its support in after hours on Thursday, and overnight Thursday, things picked back up again. We ended up opening up on Friday and had almost like a trend day where we just opened up and rose all day long. So there was nothing but buyers. All of a sudden, all of the selling that we saw throughout some of last week, all the way up through Thursday, just kind of disappeared on Friday, and buyers stepped back in, and now we're back up near all-time highs. So the good news is we held. The good news is key areas of the market held, did not break down. And then finally, the other good news is that we are seeing money rotating into areas, more money rotating into areas like industrials and financials than we are seeing money rotating into like the utilities, real estate, and staples. Staples have had a pretty good run of late, especially in 2026. But prior to that, back in November, December, staples really weren't doing anything either. So I guess what I'm trying to say is, I still think we have a choppy, volatile, not so great year ahead. That's just my opinion. But I think the downside potential probably is more limited now, given that we have held support, and more importantly, that we've seen so much strength in industrials, especially transports. I'm going to talk a little bit more about transports today, and we'll take a look at some charts that show you when transports are doing well. It's very, very rare that the S&P 500 doesn't move higher. So if we continue to do well in transports, it's really difficult for me to see the S&P 500 taking any kind of meaningful move to the downside. So I don't know if we just saw our low for the year with that move down below 6,800 on the S&P 500, but I do think it's possible that could have been the low, and that maybe we're just going to be in this choppy, range-bound kind of area for a while. Maybe we'll go through periods where we get a little bit of strength, get through 7,000, maybe even move into the low 7,000, 71, 7,200, and then maybe hit another snag and pull back a little bit. But I really thought it was key holding on to the support levels that we did hold on to last week. We got the non-farm payrolls out today. Last Friday's report was delayed because of the brief government shutdown at the beginning of the month. And so they came out this morning. And I actually thought that was about perfect, the number. We came in, I think it was 55,000, our non-farm payrolls. And I think the expectation was around 50. So it wasn't too hot. It wasn't too cold. It was just right. Isn't that the story of the three bears or something? Not too hot, not too cold. It was just perfect. That's
Goldilocks. Goldilocks.
Goldilocks. Wasn't that Goldilocks and the three bears?
That's right. Yeah.
Yeah, something like that. I don't know. I'm too old. I can't remember very well. But anyway, yeah. So that's kind of, it was the porridge, remember? So that's kind of what we're looking for in the market. We want something that's not too hot. We want something that's not too cold. And we just keep coming in. The jobs, I don't know. It seems like maybe somebody's back there, maybe moving them around a little bit or something. But they come in almost perfect every month, just about where you want. Because if it's too hot, then I think the Fed comes off of rate cuts. And I mean, you even could be looking at rate hikes. I mean, they haven't said anything like that. And I'm not expecting that. But that if jobs really started to pick up, that would be something that would probably be discussed more. And I don't think the market would like that, because the market's been in this rate cutting or maybe just holding rates. I think that's probably where we're going to be for the rest of the year. But rate cutting was going on for quite a while. That's what we were talking about. And that was increasing valuations in a lot of areas of the market, especially growth areas. So, yeah, I don't know, what's ultimately going to happen, but I think this jobs report coming in where it did, I think just kind of keeps it status quo. So I don't think it's going to, the Fed hawks, I don't think are going to get too much out of this report, but I don't think it's going to be, it's certainly not weak enough where everyone's going to be clamoring for rate cuts. So it just kind of stayed right where it was. Unemployment rate was as expected. I think that was 4.4%. So everything kind of came in about where we want, just kind of not go down, if that makes any sense. So anyway, pretty good news there. But let's take a look at some of the action in the market yesterday, and take a look at some of these charts I was telling you about on transports and so forth. So yesterday, I see a lot of green. The VIX coming back down, still at 17. I mean, I just, normally when you're talking about all-time highs and you're talking about the market breaking out and doing all these wonderful things and thinking everything's perfect and we're just going to go, keep going up, usually we see that VIX down around 10, 11, 12. The fact that it's at 17, and remember how the VIX is calculated, it's based on the premiums, option premiums on short-term S&P options. This is determined by market makers. So I like this sentiment indicator because it's not based on retail traders. It's a different view of sentiment. And when I see a VIX reading that's still up at 17, it's telling me the options are priced in such a way that market makers aren't sure we're not going to see some big swings. In fact, they're kind of preparing for it. And so when I said I don't see any major moves to the downside, but I see a lot of choppy, volatile action, that's one of the big reasons, because that VIX is elevated. If that VIX were to come back down, if we can, make a breakout, get through 7,000, and start to settle down in terms of the moves to the upside, get that leadership back with technology and discretionary picking back up a little bit, and continue, with transports doing well and that VIX falling back, that would be like the perfect scenario. We don't have that yet, but I do like the fact that transports have really come on, because if you think about it, this is just common sense. Transports, there's only one reason why transports go up, and that's because it's anticipated that they're going to ship more goods. This is a very cyclical group. So if transports are moving up, either Wall Street's telling us we got a strong economy or that we're going to have a strengthening economy. Now, I don't think we have a strong economy. I think we have a good economy. It's okay. I wouldn't say it's overly strong. So I think what's going on with transports is Wall Street's looking down the road and saying, hey, things are looking pretty good. And therefore, we're going to start taking our money out of some areas and putting it into transports. Now, the problem is it's coming out of technology. And so my thinking is, that we're probably not going to get any more rate cuts. If we're going to get a strengthening economy down the road and technology is going down, if we're going to have a strengthening economy down the road, you would think technology earnings are going to strengthen, which I do think they're going to, which normally would mean technology would lead. But the other factor in valuations is interest rates. And so if we're seeing signs that the economy is going to strengthen and that earnings are going to go up, but growth stocks are lagging, that tells me the other side of the equation, interest rates are having a big impact on growth stocks. Meaning, what would hold back growth stocks? If all of a sudden we say, hey, those rate cuts that we were thinking we were going to get, we're not going to get them. And so the interest rate side of the valuation picture brings down those stocks that benefit the most from lower interest rates, which are high growers, because those future earnings, because when they grow really fast and then you're discounting them back at low interest rates, lower interest rates means future earnings are more valuable. So when the thought is that interest rates are no longer going to be cut, and yet that's what we were thinking before, it's like now we've got something new that we have to introduce into the valuation model, higher interest rates than what we thought. That brings valuations down, particularly on growth stocks. So this is just my thinking. You can disagree, agree, whatever, leave some comments. I'd love to hear from you. But it's really an interesting, challenging kind of market because of the way the rotation has taken place. It's not normal. Normally it's okay, out of growth into, defensive stocks. Then when the market starts picking back up, it's back into growth. And that's not the way we've seen this unfold. And so, but with the money moving back into transports and industrials absolutely flying to start the year, that is not necessarily a bad thing. It's just that money is not rotating in a fashion that I think we're going to get lower rates. And I was thinking we would get rate cuts later this year, but I think it's going to get pushed back into 2027 and kind of a wait and see. Let's see what the economy does. The economy keeps strengthening and inflation continues to come down. The Fed might just say, hey, we're in nirvana here. No need to do anything. So we'll see. And then we got a new Fed chief coming in a couple months, which is going to kind of upset the apple cart. People are, you're going to think, well, rates are going to come down. Well, it's one person. So now, whether or not that one person can coerce, I don't know if coerce is the right word, but can rally the troops and get everybody on board for rate cuts, maybe. I mean, based on what I've seen from the Fed, I think that's an uphill battle. I think there's a lot of folks on the Fed right now that are not interested in cutting rates. So just because you put a Fed chief in there that might be more dovish doesn't necessarily mean that's going to translate into rate cuts. You've got to convince everybody else on the board that they need to cut rates. And like I said, I think that's going to be an uphill battle. We'll see. But that's down the road. But I do think that's a little bit of what's going on right now. The market just looking at things saying, hey, we may not get those rate cuts. Therefore, growth stocks come down. NASDAQ led yesterday. Technology jumped back. Technology, I'll show you in a minute on the sector chart. Technology led. We saw a bounce back in some of the software stocks, which have been beaten down so badly. You can see, let's see, AppLovin yesterday gaining more than 13%. Oracle up almost 10%. So we definitely had some software. Palantir, I had them in my fantasy stock draft that ended just a couple of days ago. The stock didn't go up. I think for the last 3 weeks, it went down every day. It was killing me. Now, of course, that draft is over, and now Palantir's probably ready to soar. That's the way it works, right? Anyway, let's move on. So within the sectors, technology, that's what I was just talking about, leading up 1.57%. Materials, 1.3%. We had 7 groups moving to the upside. 4 were down. Consumer discretionary, though, one of those groups that were down, really struggling to get much help in that discretionary area, especially with Amazon struggling after its earnings at the end of last week, which I mentioned earlier. All right, so let's take a look at these charts. So we got the Dow Jones, which I said back when we broke out above 45,000, that pattern measured to 53,000. So a lot of folks seem surprised when we finally went above 50,000. I'm not. I think our target's 53,000. I think that's where the Dow's going. And then we'll kind of reevaluate from there. But I think the Dow will reach 53,000 based on the measurement. The measurement, by the way, it's either, you could either look at this from a longer term perspective as a cup, or as maybe some sort of an inverse head and shoulder pattern. You have to go back a little bit. Let's move it back 3 years. So coming up right here, you can kind of see left shoulder, neckline, head, right side of the neckline, right shoulder, and a breakout. So you could look at it that way. You could look at this as just being a cup with a handle. Doesn't really matter. They're both continuation patterns, and we got breakouts to confirm. So this measurement from 45,000 goes down to the low, which was around 37,000. That's 8,000 Dow points. So when you break out above 45,000, add on your 8,000, that's 53,000. That is the technical target of this pattern. So I think this breakout's nice, but I don't think it ends here. We'll get some pullbacks. Watch the moving averages. They've tended to provide some pretty good support during any pullbacks on the Dow. So, maybe you've got down maybe 2 or 3% to the downside at any given point in time. But my belief is we're going to 53,000. S&P 500. S&P 500 has not been doing as well as the Dow. Still kind of struggling, going sideways. I know there was a comment on one of my videos. I don't remember if it was over the weekend or which one it was. Someone was pointing out that, hey, Tom, led us all down the wrong path. Or I'm paraphrasing, because I had said, hey, be careful back in December. Well, at the beginning of December, the S&P 500, I think we closed November at like 68.45. We're at 69.64. I mean, it's not like exactly like the S&P 500 has been flying. And if we go back to Thursday, which was just 2 trading days ago, we're actually below where we were to start the month of December. So I think caution has been an appropriate stance in this market, given all of the different warning signs that have come out. The question is always, is it worth taking the risk? It's not whether the stock market's going to go down. I've talked about this many times, and I'll keep talking about it. When I see warning signs, it's not about whether we go down or how far we go down. It's about, do you want to take the risk? Because when these signs have happened in the past, it has led to some rough periods in the market. Not every time. Sometimes during pullbacks, you see some of these warning signs start to pop up, but it's the fact that there were a lot of them popping up at the same time. That starts to increase the risk, in my opinion. So that's all this is. That's all this exercise is to let you know whether or not I believe the stock market is carrying a lot of risk or not a lot of risk. And if it's not carrying a lot of risk, I'm going to sleep like a baby at night, fully invested in the market. When I think that there are a lot of warning signs out there and there's potential turbulence ahead, I don't want to be fully invested. And I certainly don't want to be fully invested in some of the high growth areas. I mean, you can see what would be happening over the last 2 months if you were focused on a lot of those growth areas. You wouldn't be very happy right now, especially software. Software has been absolutely horrible. But the last few weeks to a month, I think we've seen some positive changes. Like I said, industrials, and I'm going to look at an industrials chart in just a little bit, but I want to keep this thing moving. But right now, S&P, nice couple of days here, trying to get back up near that 7,000 level, which is where we were. That's where the all-time high resides, just above 7,000. Wouldn't take much right now. We're pretty darn close, 0.5% away from setting a new all-time high. And I certainly think that could happen. I mean, I'm not trying to call it. I've said before, trying to call tops, it's almost impossible. Topping is a process. You think you have a top, and then you come back down. Next thing you know, you're up, challenging it again. And then, depending on the rotation, as we move back up, it could be bullish, it could be cautious. I think the most important thing is when you're sideways consolidating, if you make a breakout, what's leading that breakout? If we can break up above 7,000 and all of a sudden technology starts to lead again, that would be much better than if we break out and technology continues to lag. Doesn't really support the move. If that happens, I'm going to be saying the same thing over and over again. This is not what we want to see. This is not the way we see sustained secular bull market advances form. And that's kind of what I'm looking for, and that's why we do the research we do. NASDAQ 100, a little bit more weakness. You can see we never did make the new high. We got up close to it That was all the way back in October. So the NASDAQ 100, I mean, we're now going on our 4th month trying to set a new all-time high. So again, this is more growth-oriented index, and we're not seeing the same amount of strength that we saw or that we're seeing in the S&P or in the Dow, which is where we're seeing considerable strength. And if you look at the NASDAQ 100, last week when we were seeing all that selling, we took out lows from both January and December. Didn't quite get down to the low we saw in November, which I think is a really important low on the NASDAQ 100. That's all the way down at about 24,000. We got down to about 24.5. So we got within a couple of percent of what I think is a really big level on the NASDAQ. Small caps. I think last weekend I had talked about small caps, the fact that we came down to that, or maybe it was on Thursday. I think it might have been the video that I did for stock charts last week. But we were sitting right on the 50-day moving average, which is exactly where we bounced at the end of December to wrap up 2025. And we bounced again right off the 50. So if you look at the Russell 2000 coming off of the April low last year, we have only had one bout where we've gone below the 20-day, or excuse me, the 50-day moving average. And that was back in November. So that obviously is a pretty important low. I don't think we go back down there. But the most recent price low, around 246 or so, that could come into play if we lose the 50-day moving average. So that's something to think about. But for now, I would stick with the IWM, especially as long as it trades above its moving averages. I have no problem with it. Like the Dow, I actually think the small caps maybe not performing quite as well as the Dow because we're not at an all-time high right now, but still in an uptrend and certainly more reliable uptrend than what we've seen in the S&P. And we really don't even have an uptrend in the NASDAQ, at least not short term. Longer term, yes. Short term, I think we're just consolidating. Transport. So this is one of the charts that really has me a little bit more excited about what's going on. I love seeing this kind of a move. These are 3 white soldiers. If you're a technical analysis fan or candlestick fan, anytime you get a breakout like this and you do it with 3 days in a row of just finishing, opening near the low and finishing near the high, 3 solid days. That's a sign to me. And you can look down, you can see volume pretty heavy on those days. That's just a sign to me of accumulation in an area, like I said, that's only going to go up if the market is expecting more goods to be shipped. There's no other reason for transports to go up. So if transports are going up, it's usually a testament to the probability or the likelihood of a strengthening economy ahead. So I like what's going on here. So let's take a look at the S&P 500. This is a 20-year weekly chart. And this is something I bring up a lot of times at Market Vision events at the beginning of the year. Because transports are really important to follow, because when transports break down trends or when they just break consolidation and they start to move, that's what these blue arrows represent here. When the transports, and I think you can see they're definitely moving right now. When transports move, that tends to coincide with the more bullish S&P 500 moves. I mean, I'm not making anything up. You can look at this, pick it apart however you like. But the way I see it is when the transports are trending down, or they're just like in this sideways or slightly, down phase, it tends to coincide with the stock market not really doing much of anything. And that's where we were really, at least until the second quarter of 2025. And honestly, I could annotate this and I could look at something like this and just say, whoops, I grabbed the wrong one. Here we go. I mean, I could say it was something like that. And really, it wasn't until the fourth quarter that we started to make this breakout. And obviously, you can see the low was prior to the fourth quarter. But to me, it just looks like a more definitive uptrend and breakout in the fourth quarter, taking out this period of consolidation. This was a big move down, a rally, and maybe we roll over and go back to the downside. Well, this move since November has really kind of squashed that. And this move is what's leading industrials to the upside. So that would kind of change this a little bit, because then we would say, okay, this is kind of the period right here on the S&P 500 while the transports were struggling a little bit. This we just kind of, and we could say, okay, we're just now starting on this breakout. So one of the reasons why I'm a little bit more encouraged about not going down much further on the S&P 500 is because of this recent push to the upside and breakout in the transports and the move up in industrials. This was actually something that was similar to what we saw back in 2013. Now, 2013 was when we started this secular bull market advance. Some say it's 2009. I understand that. But 2013 is when the S&P broke out above the high in 2007 and 2000. So we got up to the prior double top. It was around 1550, 1560 on the S&P 500. We could have rolled over. We didn't know we were going to break out until we actually broke out. And that breakout was in the second week of April in 2013. Now, when we first made that breakout, technology was not leading it. There was a lengthy period where technology lagged the S&P 500 while the S&P was going up. But you know what was leading? Transports and industrials. Here's 2013. We had just gotten that breakout in transports. Doesn't that look a little similar to here? Here, look at the transports moving up, and here was the S&P. So here was that sideways consolidation. We opened 2013 with a breakout in transports. Now, over the next 2 years, or a little over 2 years, we went up 44%. So it wasn't like this 2-year period where we went up 96%, or this 20-month period where we went up 107%, but it was still, we went up. And you can see there wasn't a whole lot of movement to the downside. And so I think the fact that transports are moving up, that could steady us a little bit in the S&P 500. And that's why I'm thinking maybe the downside might not be as bad as I thought. But this is an evolving. I mean, the thing with the stock market is it keeps changing. We have different news that comes out all the time. We don't know what's going to happen. What's going to happen when the Fed gets the new Fed chief? We don't know. Got some people saying, okay, rates going to come down. Others saying it's not going to make a difference. This is where we should be putting our money, or that's where we should be putting our money. But until we actually start to see the impact and the way the market reacts to that, very difficult to make these calls. So the market is ever changing. I think we do a pretty good job of looking out and seeing what's taking place in the market and being able to give a pretty good forecast, like an annual forecast. We've been doing it for the last 7 years. I think we've done a really good job of that. But this is not an exact science. I mean, anybody wants to try this, feel free. Put your comments in all my videos and let me know where you think the market's going over the next couple of weeks or couple months or even a year, because it's not easy to put your, neck on the line and then try to, watch as all the other signals come in and things change to try to see, is that impacting my calls? Is it not? Are we going to see any kind of a difference? Well, transport's breaking out, moving like this is one thing that I think does move the needle a little bit for the market. All right, if you are new to EarningsBeats and you like what we do, please hit that like button, subscribe to our channel. That will really help us. Also, if you go over to EarningsBeats, you'll see right here, you can start your no-cost trial by simply hitting that green button. It is a 30-day free trial. You will have to give credit card, but we will reach out to you before your 30 days expires and let you know you're going to expire. So you need to do something, either cancel, or if you want to stay with us, we're going to give you a great annual deal at that point, try and save you a lot of money. But if you are new and you just want to learn a little bit more about us, we have a free newsletter. EarningsBeats Digest, name, email address. That's all it takes. Hit that subscribe button. We do email this out twice a week, Mondays and Wednesdays primarily. Just learn more about the things that are important to us. So that's a great way to learn more. All right, almost ready to end it, but I wanted to show you a couple more charts real quick. XLK technology. So I said that we had a kick save at a major support level, and this is what I'm talking about. This prior high in August, we had sideways consolidated. We broke out. We came back. We tested it. We broke further out, came back, almost tested it. Made new highs, came back. We tested it. Made a couple more intermediate highs, short-term highs, not an all-time high. And then we came back down. We tested it again. when you are testing a level like this many times, and look at the volume that was coming in. That's why for me, this is a perfect example of when I say that the combination of price and volume are so important. Some might look at this and say, look at, we're going down big time and look at that volume picking up. That's bearish. Well, it is, except we didn't lose any major support levels. That's why it's the combination. If you get that kind of volume coming in and you get a breakdown, to me, that's a much, much more bearish development than if you break down on light volume, or if you come down on heavy volume but hold support, which is what we did. We never broke down. And now look at the XLK moving back up and quickly moving from 135 back to 143, which is almost half of the way back to the all-time high. If technology can continue this is great news for the market. Now, I got to see it. Right now, we're just moving up, testing the moving averages. For all we know, maybe we test the moving averages and roll back over again. So like I said, it's a constant evaluation of what's going on in the market. But that was a very, very important kick save, my hockey reference, and a very important kick save for the bulls to hold up technology above that support level. XLI, and this is what I was talking about. XLI has been absolutely on fire, and transports are a part of this group. But if you look at the industry groups, almost all of the industrial industry groups relative to the S&P 500 are almost shooting straight up right now. It's just pick one, throw a dart at the industry groups in industrials, and you are likely to hit one that is soaring right now relative to the S&P 500. And to maybe Claire, or to show you this really quickly, because I'm running out of time here. But let's go in. I want to show you, here is the relative strength of the industry groups. I'm going to fast forward down here to the industrials. All right, here's one that's been picking up somewhat, but as we go through, you'll see more and more. There's trucking. Now, this is relative. This is the movement relative to the S&P 500. So we know the S&P 500 went down, but now it's starting to bounce back up again. This is relative to what the S&P's been doing. Business support services, not a strong area. Diversified industrials, look at the move in January, massive. Industrial suppliers, massive move. Defense, most of this was December, but massive move. Heavy construction, continuing just to pour it on. Industrial machineries, huge move in January. Railroads, for the first time in years, breaking out, and that occurred in January. Marine transportation was mostly fourth quarter. That's kind of pulled back a little bit. Building materials and fixtures, second half of January into February. Aerospace, December mostly, but that's been going up for a while. Commercial vehicles and trucks as strong as any area right now. Delivery services up. These are all industrial areas. Here, airlines, last 3 or 4 months, moving up. And then we get into the financials. What was it? Maybe 2 industry groups that weren't doing very well. Business support services, and there might have been one other. All the others just literally just going straight up. That's where all the money is rotating right now, into the industrials. And to me, that, like I said earlier, that's a more aggressive value investment. A lot of these are dividend payers, but they also are cyclical in nature. And when the markets, or when the economy strengthens, their earnings tend to move up very quickly. And so they're being rewarded for that. And then lastly, financials. I'm kind of watching to see if we get like a little bit of a cup here. Looks like the right side of a cup. Really like to see the financials break up above about $54.50, especially above $55. I think that would be a good look on financials. All right, let's see. It is just a couple minutes after the market has opened. Let's just see where the market is right now. Yeah, seeing mostly green. Mid caps down just slightly. Everything else up fractionally. Looks like a little bit more strength moving back into the Dow again. So I'm guessing maybe our sectors are maybe favoring industrials again. Let's see. No, actually, industrial is kind of in the middle down here. Discretionary, utilities, communication services. So 2 of the 3 aggressive groups, really aggressive groups, consumer discretionary and communication services, up near the top. Technology taking a little break, flat today. Keep an eye on technology. If we see this group moving up the leaderboard later today and the market's gaining ground, trying to break out, that would be nirvana. That's really what we want to see. Anyhow, that's it for me today. Have a great rest of your week, everybody. Happy trading.